Bond ladders have become a fairly popular topic of discussion for many fixed income investors. Today we have with us Wes Crill from Dimensional Fund Advisors. And Wes, you have researched this topic, and what have you found about using bond ladders versus bond funds?
I think bond ladders, like most things investment related, are a trade-off. So many investors will use them to try and decrease the uncertainty around meeting future cash flows. You can think about it as sort of a conveyor belt that's delivering these proceeds from maturing bonds. So you might have, for example, a 5-year bond ladder might have bonds that are in even increments throughout that 0 to 5-year spectrum. And that does increase the reliability potentially of meeting future cash flows. But it comes at the cost potentially of expected returns. Because if you think about what yield curves tell us about expected returns for bonds, well, there's information and prices about which segment of the yield curve has the highest expected return. And that's information that is essentially being discarded when you're taking a bond ladder type of approach. In fact, the spread and yield to maturity for a 0 to 5-year segment of bonds is about 1.5 percentage points. So clearly there's big differences in expected returns for bonds within that segment. The advantage with a bond fund that has flexibility is you can use the information in bond yields, use the shape of the yield curve, and identify the highest expected return segment and focus purchases of bonds there rather than having to hold everything pro rata throughout that maturity segment. So it's just different trade-offs, but if I'm an investor who's looking to increase expected returns, it can potentially be done more reliably through a bond fund rather than a ladder.
And again, a bond ladder is where you take bonds like US Treasuries and you just ladder the maturities, correct?
Yeah, a really simple example would be if I have a 5-year bond ladder and I started off with holding a 1-year bond, a 2-year bond, a 3-year bond, a 4-year bond, and a 5-year bond. And then as you roll through time, what happens is obviously those bonds are decreasing in time until maturity. And after 1 year, your shortest dated bond will mature. You can take the proceeds, use it for whatever cash flows. And then on the other end, you will have a purchase that goes into the bond on the longest portion of the ladder. So then when that 1-year bond matures, the 5-year bond is turned into a 4-year bond, and now you buy a new 5-year bond. And so you can see that can happen in perpetuity, and you have just a continuous flow of cash flows that can be sourced from that. But again, what that means is you're not going to be targeting bonds based on their expected return. You're going to be targeting them to maintain this even spacing of the ladder rungs.
Okay. Well, maybe I'm just not catching on, but why would you do that? I mean, you're going to get into markups for individual bonds, which can be pretty large when you're buying individual securities, correct?
So if you're going to be holding the bond to maturity, you know you're going to get the proceeds at maturity, absent some sort of default, which again for the U.S. will be very unlikely. That's why many investors do this with U.S. Treasuries. So what that means is you know what the proceeds are going to be. Now, you don't know necessarily what they're going to be worth if you're worried about, say, inflation or reinvestment risk might be another issue if you're not going to be using those proceeds. But if I have $100 worth of proceeds I expect to receive from a maturing bond, then I know I have that when that bond is going to be maturing. Now, when in the case of a bond fund, you can have changes in the value of the shares of that bond fund if the value of the underlying bonds changes through time. So if interest rates go up, then the value of that bond portfolio might go down. And so the value of my portfolio at a point in time in the future might have more uncertainty associated with it. So that's the reason why some investors, if they're looking for the psychological security of knowing what those proceeds are going to be at different segments of time in the future, they might see value in that. Again, it's just a trade-off.
And it seems like a very, very conservative way to go, where you're trading off expected returns, flexibility, having a large fund company like yourselves have a bond desk of professionals to pick out and to negotiate prices for individual bonds. It seems like you're really kind of creating a mess. Would that be too strong?
I think, again, it's a trade-off. So, and that tends to be the case. If you're lowering your uncertainty somewhere, you're likely going to be forfeiting something else in terms of a benefit. And so in this case, you're lowering the uncertainty around meeting future cash flows because you know what these proceeds are going to be. I already mentioned the hit to expected returns potentially for not being able to prioritize the segments of the bond market with the highest expected returns. But to your point, you're also losing out on other aspects of a bond fund that come with economies of scale. Like, for example, lowering your trade costs when you're transacting in these bonds. Also, your ability, again, if you're only holding a small subset of bonds, and if you're prioritizing the reduction of uncertainty around cash flows in the future, that greatly inhibits your ability to take on any kind of credit exposure. So if you believe that there is the opportunity to increase expected returns by taking on some exposure beyond just, U.S. Treasury credit quality, then that's harder to do if you don't have the broad diversification, which would be part and parcel of a bond mutual fund.
Okay. Well, thank you again, Wes.
Yeah, of course.